Asia just pulled the plug on borrowing in US dollars overnight. And before the world even had time to blink, Bessent turned around and told global investors to start buying US debt. Yes, buy it now, buy it fast, buy it before the window slams shut. If you're wondering why this matters to you, to your money, to your future, stay right where you are. Because what just happened is bigger than a headline. It's a signal. And when signals show up in global finance, you either pay attention or you pay the price. Comment, I see through the fog. Clarity is power. Asia pulling back from USD borrowing is not just a financial adjustment. It is a strategic recalibration with deep geopolitical meaning. When major Asian economies choose to step back from borrowing in US dollars, they are signaling a shift in their economic priorities, their risk tolerance, and their long-term positioning. Many countries in Asia have relied on the USD for decades because it offered stability, liquidity, and global acceptance. So when they suddenly reduce or cancel USD borrowing, it reflects a deliberate attempt to lessen exposure to American monetary policy, US interest rate swings, and dollar-denominated debt obligations. This move often happens during periods of uncertainty, when global interest rates are high, or when geopolitical tensions increase. By distancing themselves from the dollar, Asian nations are trying to insulate their economies from external shocks and avoid being caught in a cycle where the cost of servicing USD debt becomes unpredictable or too expensive. It also allows them to explore alternatives such as borrowing in their own local currencies or turning to regional financial structures that offer more control and fewer dependencies. This shift changes the dynamics of international finance. When Asia pulls back, global demand for USD funding contracts. That affects liquidity, borrowing costs, and investor sentiment across multiple markets. It signals to the rest of the world that regions are no longer automatically aligned with US financial dominance, and that they are preparing for a more multipolar financial environment where the dollar may not be the only heavyweight. At the same time, stepping away from USD borrowing reduces the leverage the US has traditionally held over global capital flows. It introduces new uncertainties because alternative borrowing channels often come with new risks and less established support systems. Investors notice this immediately. A reduction in Asia's USD borrowing is often interpreted as a sign that economies are bracing for volatility or tightening financial conditions at home. It creates a ripple effect that can influence currency markets, commodity prices, and global debt structures. Countries and investors become more cautious, reassessing where to place their money, how to manage their exposures, and whether this shift is temporary or the beginning of a broader move away from dollar-centric finance. Bessent's call for global investors to buy U.S. debt reflects more than confidence. It reflects a strategic assessment of where stability still exists in a rapidly shifting financial landscape. When influential investors or fund managers make such bold recommendations, they do it because they see a combination of risk, opportunity, and structural strength that others might be missing. In moments when global markets feel uncertain, like when Asia cuts back on dollar borrowing, investors seek an anchor, a place where volatility is lower and returns, even if modest, are predictable. U.S. debt has traditionally served that role, acting as a safe haven when the rest of the world appears unstable. By urging global investors to increase their exposure to U.S. Treasuries, Bessent is essentially saying that despite growing geopolitical tensions, despite rising costs, and despite questions about debt, sustainability, the U.S. remains the most reliable debtor on the planet. That reliability comes from several factors. The United States controls the world's reserve currency, has deep and liquid bond markets, and has a long history of meeting its obligations. Even during crises, investors tend to flock to U.S. bonds because they trust the system behind them. When someone with influence calls attention to this, they are reinforcing a pattern that repeats throughout history. Global uncertainty pushes capital toward American stability. This recommendation also sends a message about comparative risk. If Asia is stepping back from the dollar, it means they're bracing for challenges or repositioning for future strategy. That creates a gap in the global financial ecosystem, a vacuum where confidence needs to settle somewhere. Bessent suggesting U.S. debt is his way of pointing to where he believes the safest landing still is. Investors don't just want returns, they want predictability, liquidity, and protections against shocks. U.S. Treasuries offer that mix even when yields fluctuate or political noise gets loud. This call also has implications for how markets behave. When influential voices push investors toward one asset class, demand can rise quickly, impacting yields and strengthening the dollar. It signals that the world's biggest investors still view the U.S. as the central pillar of global finance, even as other regions test alternatives. It's a reminder that in times of economic recalibration, the safest choice for many remains the one backed by history, scale, and global trust. A sudden shift in borrowing behavior, especially by major regions like Asia, can create powerful disruptions across global markets because borrowing is not just a financial action. It is a reflection of confidence, liquidity, and long-term economic direction. When a region changes its borrowing pattern, whether by reducing, pausing, or canceling USD borrowing, it immediately alters the flow of capital in and out of the global financial system. Investors, banks, and governments around the world watch these movements closely because they signal whether a region is preparing for growth, tightening due to pressure, or repositioning to avoid future risks. These shifts can happen quietly on paper, but the impact spreads quickly. Global liquidity is sensitive to any change in large-scale borrowing. When countries borrow less in a dominant currency like the US dollar, it means fewer dollar-denominated bonds, fewer cross-border flows, and fewer opportunities for foreign investors to park money in stable debt instruments. This reduction can tighten financial conditions globally, similar to how a sudden decrease in water flow affects an entire river system. It creates scarcity, raises the cost of capital, and forces investors to redistribute their funds elsewhere. Even small changes in major markets can magnify into large psychological reactions because markets depend not just on numbers, but on expectations. Investor psychology becomes fragile during these moments. Markets are built on anticipation, fear, and the belief that trends will continue. When a major region pulls back, investors start questioning broader stability. Are interest rates rising too quickly? Is a recession coming? Is the region protecting itself from upcoming turmoil? These questions ripple through portfolios, trading desks, and central bank decisions. Investors may become more conservative, pull money into safer assets, or hedge aggressively. This creates a feedback loop where uncertainty breeds more uncertainty. Such behavior shifts can also distort currency values, bond yields, and commodity prices because financial markets are deeply interconnected. The cancellation or reduction of borrowing signals that something fundamental is changing beneath the surface. It doesn't just stop at Asia or the United States, it reshapes global risk taking, lending appetite, and how investors interpret the next move. Even if the shift is temporary, the psychological shock can linger, influencing decisions far beyond the initial event. Rising demand for U.S. debt can strengthen the dollar in the short term because global investors move their capital into dollar denominated assets when they feel uncertain or when influential voices signal safety in American bonds. Whenever demand rises, investors must buy dollars first to purchase U.S. Treasuries, and that inflow naturally pushes the value of the dollar higher. A stronger dollar may seem like a sign of stability, but it also creates a more volatile environment, especially when the shift happens suddenly or during a period of geopolitical tension. Higher demand compresses yields, tightens global financial conditions, and forces other economies, especially those with dollar denominated debt, to adapt quickly. This dynamic becomes even more complex when it happens at the same time Asia reduces or cancels its USD borrowing. When one side pulls away from dollar exposure and the other side piles into it, currency markets can swing sharply. Investors may interpret rising dollar strength as a temporary reaction rather than a long-term trend, which adds a layer of uncertainty. Volatility increases because markets are not responding to growth or confidence alone. They are reacting to fear, repositioning, and sudden liquidity shifts. These conditions create rapid movements in exchange rates, bond yields, and risk assets as investors try to determine whether the dollar's rise is sustainable or simply a knee-jerk response to global tension. A stronger dollar also puts pressure on emerging markets that rely on importing goods or servicing debts in dollars. When the dollar surges, their costs rise sharply, which can trigger inflation, slow growth, or force central banks to raise rates. That's why increased demand for U.S. debt can create instability far from American borders. It pulls capital out of riskier markets, reduces global liquidity, and leaves other regions more exposed to shocks. Meanwhile, within the United States, rising demand can shift expectations about future monetary policy. If yields fall because of heavy buying, it may influence how investors view inflation, rate cuts, or recession risks. The combination of rising demand, shifting geopolitical behavior, and sudden capital flows makes the dollar's strength a double-edged sword. It reassures some investors while simultaneously raising the stakes for everyone else, creating conditions where even small announcements or policy changes can cause outsized reactions. Investors around the world are constantly evaluating where to place their capital, and when Asia steps back from USD borrowing, it forces a global reassessment. Suddenly, investors must choose between the stability offered by U.S. debt and the more cautious, inward-looking position taken by Asian economies. This moment becomes a crossroads. On one side, there is the long-standing belief that the U.S. is the safest place to store value, backed by deep markets, reliable institutions, and the dominance of the dollar. On the other side, there is Asia, signaling that it wants to reduce exposure to dollar fluctuations and take more control over its own financial environment. Investors interpret this contrast as a clue about where global power and risk may be shifting. When Asia tightens its borrowing stance, it sends a message that it may be preparing for more self reliance or anticipating economic headwinds. That makes some investors nervous, especially those who keep significant exposure in Asian markets. They begin to wonder whether Asia's retreat is a sign of future volatility or a strategic move to avoid external shocks. At the same time, if major voices in finance are urging investors to buy US debt, it creates a pull toward the perceived safety of American assets. This push and pull dynamic forces investors into a decision making mode rather than passive participation. Choosing US debt means choosing predictability. It means trusting the dollar, trusting treasuries, and accepting lower but safer returns. Investors who fear global instability often gravitate toward this option because it allows them to preserve capital rather than chase aggressive gains. But this choice also comes with consequences. When large amounts of capital move into US bonds, yields fall, currencies shift, and riskier markets lose liquidity. That can create a chain reaction where emerging economies face tighter financial conditions and investors feel compelled to double down on safe assets. On the other hand, choosing Asia's tighter stance means betting on resilience, domestic strength, and long term independence from the dollar. It can appeal to investors who believe the global financial system is moving toward greater regional diversification. The tension between these two choices reflects the uncertainty in today's markets. Every investor is essentially deciding whether to follow historic safety or to anticipate a new financial order forming. The United States has long been considered the world's last safe harbor, and moments like Asia stepping back from USD borrowing only reinforce that perception. When global markets become uncertain, investors instinctively search for places where their money can be protected from volatility, political instability, and sudden shifts in monetary policy. The US has earned this reputation over decades because of its massive liquid financial markets, its strong institutional framework, and its consistent ability to meet debt obligations. Even when internal challenges surface, the US is still viewed as more stable than most other regions, which is why capital flows toward American assets when tension rises abroad. When Asia limits or cancels its USD borrowing, it creates a signal that something is shifting in the global financial landscape. Investors who rely on clarity see this as a moment of potential turbulence. As they search for stability, they gravitate toward US Treasuries, which have a long history of functioning as a refuge during uncertain times. The size and depth of the US debt market allow investors to move large sums of money without destabilizing the system, something many other countries simply cannot accommodate. This ability to absorb massive inflows makes the US uniquely positioned during crises. At the same time, the US dollar maintains its dominance because so many international transactions, commodities, and reserves depend on it. Even if global powers attempt to diversify away from the dollar, no alternative has yet shown the same level of trust, transparency, or global reach. This reinforces the perception that in volatile moments, returning to US assets is the safest move. Investors know that if they need liquidity, they can exit US debt without fear of the market freezing or collapsing, which is not always the case elsewhere. However, this reliance on the US as a safe harbor also creates pressure. Sudden inflows can push the dollar higher, reduce yields, and intensify global imbalances. But for investors seeking shelter, these side effects matter far less than preserving capital. In their eyes, the U.S. remains the anchor in a world where financial currents can shift quickly and unpredictably, making everyone look for the strongest ground to stand on. The interconnectedness of global debt markets means that any significant change in borrowing behavior can have ripple effects that are felt far beyond the originating region. When Asia cancels or reduces its USD borrowing, it doesn't just affect the countries directly involved. It sends signals to banks, investors, and governments worldwide that the flow of capital is shifting. Global markets operate on confidence, and confidence is fragile. A change in one major player's behavior can alter expectations everywhere, influencing decisions on lending, investing, and risk management. This is why global debt markets are both powerful and vulnerable. One sudden move can create consequences that spread rapidly across multiple economies. Interconnected markets are like a web. A disruption in one area can pull at multiple points simultaneously. For example, if Asia reduces dollar borrowing, there is less demand for U.S. treasuries from that region, potentially putting upward pressure on yields if other investors do not fill the gap. At the same time, investors anticipating turbulence may flock to U.S. debt, creating a surge in capital inflows that strengthens the dollar. These opposing forces produce volatility, which can affect foreign exchange rates, bond prices, and even stock markets around the world. The system relies heavily on predictable flows, and when a major player steps back, it challenges that predictability. The fragility of global debt markets is also evident in the psychological impact on investors. Decisions in finance are not made purely on data. They are made on expectations and perceptions of risk. A signal that a region is pulling away from dollar borrowing can lead to increased caution, portfolio rebalancing, and hedging strategies across multiple markets. This behavior can amplify the original move, turning a single regional decision into a global phenomenon. Financial institutions may adjust lending standards, central banks may modify policy, and investors may reduce exposure to perceived riskier assets, creating a chain reaction. Moreover, interconnectedness means that consequences are not linear. Small adjustments in one part of the system can magnify disproportionately elsewhere. Emerging markets with dollar-denominated debt may experience sudden cost increases, while investors seeking safe returns pile into U.S. assets. Even economies that are not directly involved feel the pressure because global liquidity, interest rates, and capital flows are all linked. This complexity underscores how fragile and sensitive the international debt system is, and why seemingly isolated decisions can have worldwide implications. Ordinary people are often unaware of how shifts in global borrowing behavior can directly impact their financial lives. But the truth is that these movements affect everything from savings to inflation to long-term economic stability. When major regions like Asia reduce or cancel USD borrowing, it changes the flow of capital worldwide, influencing interest rates, currency values, and investment opportunities. Even if an individual does not invest directly in international bonds or markets, these changes filter down to everyday life through mortgage rates, loan costs, and the purchasing power of their money. A strong dollar, for example, may make imports cheaper, but it can also make U.S. exports less competitive, affecting jobs and economic growth. The interplay between global borrowing and U.S. debt markets is a central factor. When influential investors are urged to buy U.S. debt, capital flows into treasuries, stabilizing the American financial system but also impacting global liquidity. This can reduce the availability of capital elsewhere, affecting everything from corporate borrowing to infrastructure funding in other countries. Ordinary savers might notice this indirectly through changes in interest rates offered on savings accounts, the cost of credit, or even fluctuations in pension fund performance. These are not abstract concepts. They shape how people plan for their futures and manage their resources. Inflation is another critical connection. When large amounts of money move into U.S. debt, it can influence the dollar's strength and affect commodity prices globally. For instance, a stronger dollar often pushes commodity costs lower in dollar terms, but can create instability in countries that rely on exporting goods priced in dollars. This, in turn, can affect global supply chains, pricing for imported goods, and the overall cost of living. Families may see rising or falling prices depending on how these capital flows influence their local economy. Understanding these dynamics empowers ordinary people to make smarter financial choices by recognizing that global debt markets are interconnected with personal finances. Individuals can anticipate risks, adjust investment strategies, and avoid being blindsided by sudden shifts in the financial environment. Awareness allows people to navigate uncertainty, preserve wealth, and protect their economic future. Even small changes in global borrowing patterns can ripple outward, reminding everyone that no one is truly insulated from the movements of the international financial system.